Many of you watched my last video on 3 hated stocks to consider investing in 2023, and I did mention the retail sectors that a lot of beaten down stocks. They are in the retail, they're pretty beaten down, and I think there's a lot of value in this sector, and I'm personally buying a lot of companies in this sector. And in this video, I'm gonna take a look at DG, Dollar General, which a lot of you have actually asked me about this stock, and it fell down a lot recently. It's trading pretty close to what it was in pre-COVID in February of 2020. So there's a lot of fear around this stock, and there's a lot of uncertainty, and this is the situations that I like. So I'm gonna try to discuss Dollar General in today's video and try to determine if it's actually a value trap or if it's maybe a misunderstood stock that is potentially a good investment for us to actually buy. Now, in terms of Dollar General, I'm gonna look at the latest earnings, and it's been pretty much a disaster. Actually, their earnings were not bad, but the worst part about the report was actually their guidance. And if you look at their net sales growth, for 2023, it's in the range of 3.5% to 5% compared to 5.5% to 6%. Same store sales, which is very bad, 1 to 2%. Previous expectation was 3 to 3.5%. You look at EPS, approximately an 8% decline to flat. So they have no idea where the EPS is going. They tried to blame it on some macro factors, but they also blamed it on pretty much 4 percentage points just due to higher interest expense, which we're gonna talk about in this video. And the worst part, in my opinion, about the whole thing is that the company's guidance assumed no share repurchases in 2023 compared to previous expectation of purchasing $500 million worth of stock. So even though the stock could go to $160, it could go to $150, $140, most likely Dollar General is not gonna be buying back stock. This is the time to be buying. They were buying so much stock on the top pretty much. This is what companies do. And whenever stocks go down, they have a bad position in the balance sheet, in their debt profile, which I'm gonna talk about. And this actually doesn't allow them to buy back stock at much lower prices when they should be buying. So this is the worst part about the report, in my opinion. It's actually that they're not going to be able to be buying back stock in 2023. And if we look at their latest, income statement, which wasn't actually bad at all, but those are two main problems that most retailers are facing. And the first one is an increase in selling general administrative expense, SG&A. And this is mainly the employee expense, because these retail kind of stores, they do require a lot of people being there, a lot of physical presence, a lot of employees. And because we had a tight labor market, they had to give those employees higher and higher wages, sometimes 5, 6, 7% instead of 2 to 3%, which what they used to give them. And this has been pretty bad for those companies, but Dollar General actually managed it better. Now, if we look at their interest expense, which was very bad, it went from $39 million to $83 million. I mean, this is crazy. They were spending all their money buying back stock at the peak when they should not have been buying back stock. And now whenever the stock went down, they can't buy back stock because they have to pay down the debt, which is a very bad situation to be in. But the first problems that they are experiencing is higher SG&A expense, which I personally believe is temporary. Powell is trying to get unemployment higher. Eventually it's gonna come a little bit higher, and it's gonna ease the labor market a little bit, which means that they're not gonna be facing such higher SG&A expense. The second one is theft. A lot of retailers have been experiencing a lot of theft in the United States, especially Target, over $500 million of theft every single year. And this is something I posted pretty much on Twitter. I shared it, and this is a video of, I believe, some 2 people stealing something, and this is most likely, I believe, a Dollar General store. So this is what's happening in the United States. It's not funny, it's actually sad, and this is, I believe, a temporary problem. It's eventually going to be fixed. It's getting worse, but maybe it gets fixed, with a new president or some kind of new policies. But this is something else that those retailers have been experiencing, and it's really leading them to much bigger losses that most people actually expect. But I still believe it's more of a temporary issue. Now, if we look at the balance sheet and we look at the merchandise, pretty much the inventories, they went from 6.7 billion to 7.3 billion. This is a massive increase in inventories over just pretty much 3 months, over 1 quarter. This is pretty bad for the company. But the worst part about the company is actually their debt profile, because they were spending most of their money buying back stock instead of being just, paying down the debt. and they have $313 million of cash. They have $7 billion of long-term obligation and around $1.1 billion of deferred income taxes, which I do count it with the liabilities. So this is over $8 billion of debt. Now, before we make a judgment that Dollar General is not a buy, I try to look at the free cash flow profile to see if it's actually stable, and then I look at the maturity profile of this debt to try to assess if it's due later in the future, if it's a lot of maturities due within a year or two, which should be a big concern for Dollar General. But if we look at their free cash flow profile, they had stable and resilient free cash flow most of the time, except in 2023. This is not this year. It's actually the fiscal year, which is 2024 for them. So this 2024 is 2023. 2023 is actually 2022 for this company. But in terms of, most of its pretty much years since 2017, it had over $1 billion of free cash flow most of the time and expected to have over $1.6 billion for this fiscal year, which I don't believe, is bad at all. And we can see that it's actually resilient. It's not a Carnival cruise stock. It's not an airline stock. It's something where people go and buy things they mostly need and not just want. And this is why Dollar General has stable free cash flow of over $1 billion pretty much every single year. Now, if we actually go and we look at the debt profile for the company, and we can see most of the debt is pretty much due later on, but they have a 364-day revolving facility. This is $250 million. They have pretty much $750 million worth of long-term debt that's actually due in 2024. And then they have pretty much $500 million due every single year and nothing crazy before 2030. Now, the company, as we looked and as we talked about, it tends to make over $1 billion of free cash flow every single year. Those together I'm not really worried about, because from now till 2024, either they can refinance to $750 million, but I think they will most likely pay it off, which is why they can't buy back stock. They are pretty much stuck with the debt. It's $750 million due next year. They're going to have to pay back as much as possible, which is why they can't buy back stock. And then after that, even if they just make $1 billion worth of free cash flow, which is at the lower end of their historical range, they still have around $500 to $600 million due every single year, which is actually manageable along with the dividend, which they have a pretty small dividend, I believe 1.5%. So for me personally, the debt is not a big problem. I am a little bit worried of the $750 million, and then you have $250 with it. All of those are due pretty much by September of 2024, which is pretty close to a year from now. I think the company will most likely manage it, which is why, they can't buy back stocks. They have to use all the free cash flow to pay the debt. But most of the debt is structured, pretty well. And I hope they pay it off soon so they don't face, the higher interest expense. But I don't think the balance sheet is a problem with Dollar General. Now, if we look at how much we're actually paying for Dollar General, we're paying around 16 times, forward earnings, which is what the, management is expecting in terms of EPS. It's around 16 times. Now, something that's very interesting with the company, it tends to have some kind of a behavior where it actually bottoms somewhere close to, around 14 times earnings. So if we look at this line over here, how it pretty much bottomed in 2018, around 14 times, over here around 14 times, pretty much it never went below 14 times earnings. It was 13.5 in 2011, but it tends to bottom around 13 to 14 times earnings, and the company is sitting at 16 times earnings, which is, at the lower end of the range, and I tend to like to buy companies at the lower end of the range, and I think Dollar General over here, on a historical basis, if you look at the, at this line on the historical average, is pretty close to where, it was either close to a bottom or it was actually has bottomed around 15 to 14 times earnings. Now, the mean PE ratio is pretty close to 18 for the company, and now it's sitting at 16, which is again at the lower end of the mean PE ratio, which is something I like to look at. The company has pretty good returns on capital. It has been deteriorating lately because of a lot of things that they are happening. They are actually remodeling a lot of stores and spending a lot of capex, doing a lot of things. And now it's around 13%, which is still not really bad for the company at all. They also have, a good buyback program. They have been buying back a lot of stock since 2017, but now they can't do it anymore, at least not for 2024, because they have the debt that they have to deal with it. And this is sad because this is now when they should be buying back, but they can't do it because, they were not doing it the right way in terms of buying back stock. Now, this is my valuation model on, Dollar General, and I put in 4% for 2023, which is aligned to whatever, they were expecting. They expect 3 to 5%. I put in at 4%, and then the analysts, they have it at 7% from 2024 to 2027. So I put it below the analyst of around 6%, which also kind of aligns with the historical average in terms of Dollar General. And I personally believe 6% is pretty fair for the company. Their net income margins are 6.1%. I kept them at 6.1%. PE ratio, we talked about the mean PE ratio being close to 18 times earnings. So I'm betting on a small multiple expansion where it goes from 16 times back to 18 times, and this is nowhere close to where it was trading at a few months ago. I mean, in late 2022, the company was trading around 20 times earnings. I'm not saying it's going to go back to 20 times, but I believe 18 times is pretty fair for the company. I put in a 3.5% dividend, which is not a dividend. I put in the 1.5% dividends they have, and around 2% worth of buybacks, because the company has been buying back, 3%, around 5.7%, 4%. So I included a lower buyback kind of, percentage for the future because they're going to have to deal with some of the debt. So I put it 3.5%. The total is 69% on the upside, or 11% compounded every single year for the next 5 years. Now, this is actually not bad at all with a company like Dollar General. But if I want to double my money over the next 5 years, which what I try to do over the next 3 to 5 years with most companies I like to buy, I have to buy Dollar General at $138 per share. $138 per share is somewhere close to what it was, at the COVID lows, which I'm not sure if Dollar General, is going there. It's actually possible because it's not buying back stocks. There's only institutions that are buying it and investors. So it's it's possible it goes there. It's not likely, but it's possible. And this is around 15% from today's prices, which is, it's not impossible in my opinion. But this is my fair value on Dollar General. It's somewhere around $138 per share. I don't think it's a bad buy right now at 11%, but I believe there's better, opportunities in the market. So $138, this is my fair value for, Dollar General. So I put it on my watch list, and if it ever gets close to 138, 140, maybe I could consider opening a position. So this is my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.